Nebius Group has positioned itself as a key player in the rapidly expanding AI infrastructure landscape by supporting enterprises in building data centers purpose-built for artificial intelligence workloads. Much of the surge in investor interest has been fueled by a widely publicized multi-billion-dollar partnership with Microsoft. This agreement has not only validated Nebius's technical capabilities, but has also enabled the company to attract significant additional capital. At the same time, the heightened visibility has contributed to sharp swings in the share price as market sentiment around AI demand continues to shift. Beneath this volatility, the company's operational momentum remains strong. Nebius has delivered solid revenue growth driven by rising demand for AI computing resources. Management has pointed to a rapidly expanding pipeline, reflecting a meaningful increase in contracted future revenue. This reinforces the broader industry narrative that demand for advanced AI infrastructure is outpacing supply, a pattern also observed across the semiconductor, memory, and cloud computing sectors. To capitalize on this demand, Nebius is investing heavily in expanding its AI-focused infrastructure footprint. This aggressive expansion strategy carries inherent risks, particularly the possibility of building excess capacity that could become underutilized once existing contracts are fulfilled. Management argues that this risk is mitigated by structural changes in how AI is being used. AI is quickly evolving beyond text-based applications into areas such as video generation, voice interaction, and image processing. These use cases require significantly more computing power, suggesting that long-term demand for high-performance infrastructure is likely to continue rising rather than decline. Another recurring criticism is that Nebius operates in a commoditized business, essentially leasing GPUs with limited pricing power and thin margins. The company strongly challenges this view. Management positions Nebius as an emerging AI hyperscaler rather than a simple GPU rental provider. Its strategy focuses on building a comprehensive full-stack platform that includes workload orchestration, virtualization, control layers, security features, and operational tools. By combining these services with raw computing capacity, Nebius aims to differentiate its offering and generate higher margins through bundled, value-added solutions. The Microsoft partnership is central to this strategy, but it deserves careful interpretation. Large enterprise agreements often provide smaller companies with credibility and access to capital, yet they also reflect a clear imbalance in negotiating leverage. Major corporations understand the signaling power of such partnerships and frequently use it to secure favorable terms. As a result, smaller firms may accept lower margins or even near-term losses in exchange for long-term visibility, scale, and financing advantages. From an investment standpoint, the real importance of the Microsoft agreement lies less in near-term profitability and more in its ability to unlock funding. The partnership reassures lenders and investors that Nebius has committed customers for the infrastructure it is building, lowering perceived risk and improving access to capital markets. This flexibility is particularly important for a business that requires substantial upfront investment in a fast-moving technological environment. Management has indicated that core operations are approaching profitability, with expectations that the broader group's results will stabilize as scale efficiencies and operating leverage improve. The company's conservative approach to depreciating AI hardware also reflects a cautious stance on asset lifespans and financial reporting, helping to avoid overstating earnings during the investment phase. The valuation of Nebius Group in this analysis is primarily based on a discounted cash flow (DCF) approach rather than traditional multiple-based metrics. The estimated intrinsic value is approximately $110 per share, compared with a current market price of around $90 per share. This difference suggests that the stock remains undervalued even after a recent increase in the share price. Crucially, this valuation already includes a margin of safety, meaning the upside does not rely on overly optimistic assumptions. The valuation is supported by several internal factors, including strong revenue growth, a rapidly expanding order book, and management's expectation that the broader group will reach EBITDA break-even. Over the longer term, operating margins in the 20–30% range are assumed, driven by economies of scale, operating leverage, and proprietary infrastructure development. The valuation also reflects conservative financial assumptions, particularly with respect to capital intensity and depreciation. Nebius depreciates its AI hardware over a 4-year period, which dampens near-term profitability but enhances the credibility of long-term cash flow projections. Ultimately, the valuation thesis depends on Nebius successfully transitioning from an investment-heavy phase into a scaled cash-generating AI infrastructure business. At present, 8 analysts cover Nebius Group. 7 have issued buy ratings, while 1 has a sell rating. Analyst price targets range from a low of $110 to a high of $211, with a median target of $150 over a 12-month horizon. Based on both my valuation work and the broader analyst consensus, a price target in the 140–150 range appears reasonable over the next year. Despite the apparent undervaluation, Nebius should be viewed as a high-risk investment. The potential upside is meaningful, but it is suitable only for investors who are comfortable with significant volatility and execution risk. In conclusion, Nebius Group represents a leveraged play on the continued growth of AI computing demand. Its ambition to move beyond commoditized infrastructure and toward a more integrated AI platform could support margin expansion over time, though execution risk remains substantial. The stock offers attractive upside potential, but only for investors willing to accept elevated risk in pursuit of that reward. This is not financial advice. Happy investing!